Hi, and a warm welcome to MFB Live. Thank you so much for joining us today. It's lovely to see your faces, and we really appreciate you taking the time to join us. My name's Jenny Brown. I'm the Business Development Director here at Mortgages for Business. Now, look, when we were thinking about the kind of content that we're going to be having in our spring 2021 edition of MFB Live, we really wanted to be sure to curate something which was going to be absolutely of interest and relevant in terms of what people are interested in right now. So what we did is we really cast our minds back to conversations we've been having with our clients of late in terms of the kinds of things that they're interested in and considering as their next kind of investment decision, or equally a kind of change to their existing portfolio by way of diversification. And what we were really able to define is there were three key areas that people were notably more interested in than they would have been previously. We also then took a look at the data that comes in from our website in terms of what people are looking at, the kind of things people are, articles that people are particularly reading. And then we looked at Google search terms. And this really, interestingly and thankfully, just continued to back up the information about these three key areas. And that leads us really nicely onto our agenda for today. So first of all, we're going to be joined by David Whittaker, where we're going to be talking about financing multi-unit properties. I'm then going to be speaking to Andy Ellery about holiday let financing. And then lastly, I'm going to be talking to Mark Posniak about refurbishment and development finance, and also the kinds of things that you can actually do under permitted development. So my first guest today, therefore, is David Whittaker. David is CEO of Keystone Property Finance. Now, we know David very well. He is a very good friend of Mortgages for Business. David has been in the industry for many, many years, and his understanding and knowledge and experience is absolutely first class. It's also well known that David does like to tell it like it is, so I'm very intrigued and excited to hear what he's going to have to say to us today. So we're delighted to have him here to talk to us about multi-unit properties. David, thank you so much for joining us today. We really appreciate you taking time to come and have a chat with us. So look, right now, we're definitely seeing that landlords are looking to their portfolios and considering broadening their range of assets. And we see this not only reflected in the data that we're seeing, so for example, search terms on Google, but also in the sort of analytics of what people are reading about on our website, and also the types of conversations that we're having with our clients. Now, one of the types of assets which we're definitely seeing an increase of interest in is multi-units. So I guess my first question to you is, why are so many more landlords now considering multi-unit properties as an investment vehicle?
Yeah, okay. Well, I don't think any landlord or potential landlord wakes up on a Monday morning and says, right, I'm going to get into this buy-to-let sector, and the first thing I'm going to do is canter around the corner and buy a freehold block. I think they're there for two reasons. Most will start with something they understand. So they've lived in flats as a student, or when they first left home, and they've lived in a small house, and they've done that bit of the journey. So the first thing they'll do from a risk and confidence basis is buy something they know. So they won't have started there. They might have equally, a few of them have fallen into it. They've inherited a property, or when they've moved house, they've chosen to hold on to a property and they've turned that into a buy-to-let. So this isn't at the beginning of their journey. It's come somewhere along the line. And, they've been through that portfolio growth. They've acquired one or two or three or four or five or six properties. They've perhaps even done a refurbishment because they've seen they can add value. They've perhaps even done an HMO. Good luck with that. Or they've done a semi-commercial. It's all about confidence and risk, isn't it? So they've reached that point where they feel they've got a good business behind them, so they're confident about that. They understand the risks in that, and they talk to their estate agent one morning, and he says, well, I know you normally buy flats, Fred, at £250,000 a pop, and it's perhaps a yield of 4.5%. But do you know what? There's a little block in the area of the town where you normally buy, and it's 4 flats. And it's not going to be £1 million because it's 4 flats in a block. It's perhaps 900,000, but frankly, the rent is the same. So you sit back with your little scratch pad and you go, So that's a 4.5% on 250, but it's 4 flats. Do the maths, and all of a sudden it comes out as a 5% yield. So all of a sudden your yield has got up by 11%. You're a landlord and you're confident, you know the area, and say, well, yeah, I know it's 4 flats on one street, but heck, I know the area. Why wouldn't I be happy letting them out? And perhaps from a management perspective, and I've never owned one, but you say, well, it's 4 flats in the building, how much trouble is it for me to go and visit my 4 tenants to have a catch up with them when they're all in the same building? So I can see how people end up in that position. So there's also a mathematical driver for it. And of course, finally, some of that's driven by those tax changes that George Osborne brought in July of 2016, where there's a drive for yield. Yeah. If you're still owning assets in your personal name, we won't perhaps debate here whether if he or she was buying this block of flats tomorrow, whether they would put it into their own name or limited company. But, you're going to mitigate the impact of that last exercise by looking for yield. And this is one of those yield areas where you're going to get a better yield for something you understand. So those are the motivators why we see landlords going into it. And back in the day when landlords were still happy to talk to me, I can remember seeing them go through this growth pattern. And you will have too, Jenny. You've seen how they started out, and you'll see where they've got to. And as their journey goes on, you see them contemplating things that you knew they would never have done 2 or 3 years before. And whether it's confidence or risk or the need to do it because of the tax changes, this is why they end up in this space.
Yeah, I think as well, one of the other reasons that landlords have sometimes mentioned to me is people are quite nervous of leasehold arrangements. Sometimes they're not keen on having a third-party freeholder who's kind of running things, the costs that are associated. And I wonder whether sometimes people just feel that actually rather than buying 4 separate flats in different places where there's a third party running it, let's just buy our own block of flats and, be accountable and managing it yourself.
And there has been that whole debate over ground rents above £250 a year, and that we could talk about for half an hour or so. But you can see in everyone's psyche, if you've got the freehold, you do control the whole piece of real estate, don't you? Yeah. And you can only point a finger at yourself if something goes wrong on your watch, whereas 4 separate flats might be 4 different freeholders, 2 of whom could be really nice and benign, 1 of whom you might never even encounter, and the 4th one could be really quite tricky to deal with. So you can see why there's other drivers in it as well.
Yeah, absolutely. And so actually, one thing I was going to just mention to you. So one of the things that we notice is that often when landlords are looking at multi-unit blocks and finance, they often think that it's a commercial mortgage that they're looking for. Indeed, we've noticed that the number of commercial inquiries that we have coming in where people are selecting the option of a commercial inquiry, but they're actually looking to talk about multi-unit blocks. There's a real misconception, I think, in the market about how you can actually finance these.
Yeah, and I think from a historical perspective, that would have been right going back pre-credit crunch. So to the early 2000s, I think probably the only buy-to-let lender of scale who was active on freehold blocks in the day was Paragon.
Yeah.
And when I say the big beast, I use that as a matter of great respect. No one in the buy-to-let market ever walks anywhere if the big beast hasn't been there first. Whether they're very active in that area, you could then debate. So I think that's a historical perspective that's quite appropriate. But I think lenders are quite benign. If you were to come to me with a landlord who had little or no experience and said, right, the first thing they're doing is buying an 8-bedroom HMO, I'd suck my teeth in and say, right, stand by to jump through some hurdles, because an HMO is multi-tenants in one single unit. There's risk in fire systems, alarm systems, safety, HMO licensing, Article 4 directions. It's possibly not what you'd expect a landlord to do. But when it comes to a freehold block, we're quite benign on it. We place no greater hurdle in front of the landlord to buy a freehold block. We could talk about the property aspects in a moment, but there's no threshold test for a landlord on a freehold block, rather than the individual flat within that block. So I think that's the positive part of it. As to why the lenders are in this space, or indeed not in this space, you've got to roll back into history a bit. Some of the biggest players in the buy-to-let market are residential lenders at their core DNA, experience, risk, and most importantly, computer systems.
Yes.
And try lifting the bonnet on a computer system in a big lender, and people in IT departments, risk, and chief executives have heart attacks. It's the one thing that never ends up well. Time, cost, risk, money, the whole thing collapses. So it's not the sort of thing that every lender wants to do. And indeed, if they're very busy doing a really great product offering to people who own 2 or 3 properties and they don't want to go into limited companies and freehold blocks, doesn't mean they should do so. They can do a great offering and they can price down to levels I look at and go, wow, that's great, that's a great offering, but it's not for us. So Paragon always been there, and it sits in that specialist space, and rightly would have been the preserve of a commercial banker 10 years ago. But the specialist lenders are able to come in, and by virtue of more flexible systems, more experienced underwriters and risk DNA in the business, they say, yeah, we kind of get this. It's a little bit more tricky to do, but not massively tricky to do. We can absorb this, and we hope we can all do it well. But because of all of that, not everyone's going to play in that space. So if you say there's 15 or 20 participants out of the 50 in the market, and indeed we're probably not even 25 or 35% by volume, the terms are going to be slightly different because you're not feeling that pressure for competition coming in on you. And indeed, there is a slightly different position on risk, which we can probably pick up in a second. But in any other respect, it should feel like any other buy-to-let application. You should still be able to get interest only for 5, 10, 15, 20, 25, or indeed 30 years. You don't have to go for capital interest. The fees should be broadly the same. The valuation fee might be a bit more, but the lender shouldn't treat you in any other different way in terms of threshold testing as to how they come up with an offer for you. Just that, the pricing might be a bit different, and you no doubt will push me on that in a moment.
So look, I think in terms of appetite to lend and risk and that kind of vein, what kind of criteria can landlords expect when they're looking for a multi-unit purchase?
So 75% won't really go to 80%. It's rather like the same discussions you have on an HMO. It's not such a liquid asset as an ordinary house, flat, or bungalow. It's not so readily tradable. There's also the slightly trickier discussion as between the borrower and the lender and the valuer as to what these blocks are worth. So if I go back to my analogy at the beginning, 4 flats in a single freehold, each would be worth £250,000 a piece if being shelled out individually. By the fact they're getting a higher yield, you're getting a discount because it's what we call a single investor value. And the number of people that will line up to buy a £900,000 pot rather than a £250,000 pot is necessarily further up the pyramid, is somewhat more constrained. So that's one facet of a single investor value. And indeed, it's not for everyone.
Yeah.
Not everyone's going to come into this. So there's never going to be quite that level of liquidity on the market for it. Now, a seasoned landlord will say, well, of course, what I would do is I would break it up and I'd sell it off individually. But a lender isn't in that game. Well, we're not here if something goes wrong on the watch of this deal to stand in the landlord's shoes and say, well, what we'll do is we'll sit on this for 9 months, we'll create separate leases, and we'll sell it off. It's not what we're mandated to do. So that single investor value always means there's going to be a slight pinch on the value of the property, and it's a less liquid asset, which is why you'll see it more typically at 75%, which actually is where most of our borrowers are for most of their borrowers, but you won't find lenders at 80% unless they're going up the risk curve. And when you go up the risk curve, yes, you could get it to 80%, perhaps, but my goodness, you look at the difference in the interest rate, and any seasoned investor will say to you, yeah, okay, Jenny, that's very interesting, but at that price, do you know what? I'll put the extra 5% in.
Yeah.
And that's how that single investor value plays out. It's a discussion, and you can't just say, well, it's not the value of the sum of the parts. There's always a slight discounting back for the fact that it is 4 units rather than 4 separate individual leaseholds.
Yeah, I think we tend to sort of assume it's going to be around 15 to 20%. Does that sound fair to you?
Yeah, that's sort of probably, I'd say, more on the cautious end of it. So if you've got just an ordinary house that's been converted into 2 flats, I'd expect that discount to be virtually minimal, because after all, it's just 2 flats. It's as you step up through the stages, and it goes up to a point, and when you get to 5, 6, 7, or 8, where it could be that 15 or 20%, and then when you get into really large blocks, actually it starts coming back down the other way again, because the whole thing becomes a macro investment.
Right.
So that would be the worst sort of number. But as you say, there's always going to be some element, and if the landlord says, well, the breakup value is that, she says, yes, but we haven't got a breakup situation in front of us. What we're looking at is as it stands here today. The interesting point comes if a landlord says, well, here's a block of 10 and some have been sold off.
Yeah.
Will you do it? And that's where some of those lenders who say they will do these take to the hills and say, yeah, that's quite not in our DNA. And we're in, again, that cohort of 50 or 20 has now shrunk down to 6 or 8 of us. And we say, yeah, but we'd want you to be in control. We want you to have more than 50%. Because once you've lost more than 50% to the leaseholders, you've then got people who can then vote against the management company, and all sorts of other things come in. So we're happy to look at a block, and that's where that discount then starts to get quite complicated. Yeah. And that's where we just have to really say, look, I understand this is what you think is a great deal, and these are the numbers you've agreed with the freeholder who's selling off the rump of 8 units out of a 12-unit block, which is fine, that would work to our rules. Then we're really dependent on the valuer. And it's a really, what we call a red book valuation, where the valuers do a mixture of art and science. And often that's where the tension comes between the aspiration of the borrower, who can see a good deal, and the valuer saying, yeah, kind of get where you're at, but I think a different number might apply. And often that's where there's a bit of a debate.
And so 75% loan to value. Do we need landlords to have experience? Do you mind, can people have lots of properties in the background? Do they have to be earning, a certain amount of income to access mortgages for these kinds of properties? What's the kind of other criteria?
No, it is genuinely benign. So whatever rule we would apply to you if you came to me with a single flat, we'd apply it in this situation, because there are none of the extra complexities in terms of the HMO situation where we would want to see some experience. But I go right back to my sort of opening comment. It's pretty unlikely people that fall into that for the first deal. Yeah. Just because of the quantum of it, You might live in a part of Kent or Surrey and say, right, I know the area pretty well, you live there. That's not the same as renting property there.
No.
You would want to buy a couple first and then say, actually, I think this is a slam dunk area and it's always going to have strong demand. Yes, I will now buy that small block of 4 flats around the corner. Sure. So it's not that we don't expect it to happen and therefore we don't have it in the rules. We just don't perceive it from our underwriting risk any different, because you've got 4 separate tenants or groups of tenants in 4 separate flats, each with their own power supply, water, gas, lecky, and what have you, paying their own rates. So there's no difference in risk from our perspective.
And that's really interesting, actually, because whilst it's great that Keystone have that view, actually a lot of the other lenders who play in that same space with the multi-units, they actually do have a prerequisite for experience of letting before they'll let you take on a multi, or they'll fund a multi-unit. So it's really great that you take much more kind of, I guess, pragmatic view on it. That's really interesting. And I suppose keeping on the kind of, vein of risk, I think a lot of people do view multi-units as lower risk because, rather than putting my eggs in my single £900,000 house, where if I have my tenant move out, I have no tenants left, my risk in terms of my income is spread amongst multiple tenancies. And I think some landlords sometimes query why actually multi-units are regarded as a high risk. And I appreciate we've talked about the kind of resale element at the very top there. But the pricing, I think we often find as brokers, we're challenged from borrowers. So maybe you could just explain from a lender's perspective the pricing and where that's sort of risk is priced in.
One simple word: competition.
Right.
So if you're a supplier of any product in any sector, if the competition is there, that drives pricing. You will well recall that when limited companies were an option as opposed to private ownership for buy-to-let, limited company lenders, and those few of us that did it, charged more for it.
Yeah.
There is more work involved, and that's fine. But longer term, there's probably no greater risk. So why did everyone charge an extra 20 basis points? Because they could.
Good, yeah.
So at the time Osborne made his announcements in 2016, there were 8 lenders doing limited company buy-to-let. There's now, well, you'll probably tell me, 20, 25 lenders doing it.
Yeah.
So why is that differential gone? Not regulation, competition. So, but here we have an asset that isn't going to change substantially. You're not going to suddenly put up a whole load more small freehold blocks of flats, and therefore it's going to drive competition. So you'll find it sits in that specialist space, whereas you've already said not everyone chooses to do it. So those of us that choose to do it will price to get in a percentage on our book. And not all of us are balance sheet lenders. We're not banks. Yes. So Paragon is the biggest in this space, and they are a bank. They've also got the One Savings Bank brands in there that do some of this. So they will tend to lead the pack on this, and they will have a differential over their main product set, and we will have a differential over our main product set. Normally, it's about 10 to 20 basis points. Currently, it's a bit higher. And that's got nothing to do with the risk on that. That's just about all lenders controlling their volumes to try and make sure they deliver as we run up towards the stamp duty deadline. So you may see some compression of that in the future. But I don't see it being eliminated, because within my funding structure, and that probably accounts for 2/3 of the players in my space, we go to the capital markets and they say, you can have so many customers that look like this. They also say, you can have so many properties that look like that. And multi-unit freehold blocks will be part of that, what you call a portfolio limit.
Yeah.
So about 10% of our current book is done on freehold blocks of flats. We have a much larger portfolio limit than that. But if I was to suddenly swoop my pricing below someone like Paragon, and the next 20 applications that landed in a flurry at MFB was to come our way because we were the best gig in town, I'd have my risk team then saying to me, yeah, that's okay for a week or two, but you might run a bit hot. So it's an area where there's a limit for many of us in what we can do there. So we're happy to outbeat the commercial banks all day long. We're happy to offer much better terms than the commercial banks. So it's interest only, it's long-term interest only, the fees are less, and the structures are generally better. But it's not an area that yet feels that heat of competition that you would feel in the mainstream market. And whilst I've already shot myself in the foot by saying that the limited company premium went away a few years ago, this is an area where I see there will be healthy competition in it. And I think there will always still be a slight margin at the top end for these properties against what you would get for bringing the same individual flats to a lender.
Yeah, and I think also it's about perspective, isn't it? I think when I speak to some of my clients who maybe considered multi-unit purchasing years and years ago when it was a commercial offering, and then we quote the kind of pricing that is accessible to them nowadays, they're really pleasantly surprised. Actually, it's the same with the limited companies, as you rightly refer to. The conversations I was having with clients when I first started at Mortgages for Business 15 years ago, and where we are now in terms of the kind of, price differential between personal limit, it's come right down. So actually, while the multi-unit finance might feel expensive to someone who hasn't really looked at it before, when you look at where we were and the journey we've come on, actually it's very, very good. And, as you rightly say, I guess that's because we're seeing more competition coming. We just don't have quite enough yet to really start to pinch things down.
Yeah, and finally, if one was sort of looking at it from outside of either the lender or the investor viewpoint, you have an investor who's got an asset that now is yielding 5% rather than 4.5%, and you've got a lender who sees it slightly differently on risk. They would say, well, actually, there's a bit more meat on the bone here, and we're able to do something the commercial banks choose not to do so competitively. So why would we get involved in a dash to the bottom?
Yeah.
But never say never.
No.
It's a healthy area. It's an area we're very happy to be in, and that those of my peers who are in it, we compete from week to week, and you may see some pricing change over the summer more generally in the market. And this is an area where perhaps the margins have widened slightly since March of last year, and they may compress down a bit. But if you can prove me wrong by challenging me in a year's time and saying, David, that margin, what happened to it?
You promised me. So in summary then, multi-units are really good in terms of the pricing is there or thereabouts. Obviously, there are lenders like Keystone who are very keen to lend on them and support borrowers with no kind of punitive requirements in terms of experience, strong yields, control of freehold. There's loads of really great things. So I guess it really does kind of explain to some extent why we're seeing an upturn in interest from our clients and investors more broadly. So David, I think that's probably a good point to leave it. So thank you so much for taking the time to talk to me today. It's been really interesting to hear it from a lender's perspective.
Jenny, that's a pleasure, and we'll now both get back to making sure we help our customers who are trying to get stamp duty deadline transactions done.
Indeed. Thank you.
Nice catching up. Bye-bye, Jenny.
Okay, so now moving on from one buy-to-let property type, which is growing in popularity, onto another. Next, I'm delighted to be speaking with Andy Ellie, who is a senior consultant at Mortgages for Business. Now, Andy has over 25 years' experience in the financial services industry. His experience and authority on holiday let finance is honestly second to none. So if I ever get an inquiry about a holiday let that I don't know what to do with it, the first person I'm going to pick up the phone to is Andy to ask his advice. Now, Andy also is a true expert at commercial and buy-to-let finance as well. So his kind of breadth of understanding of the investment market is really, really unparalleled. So I'm really pleased he's going to be able to talk to us today and share some information about obtaining finance on holiday lets. Andy, thank you for joining me today. Really appreciate you taking time to come and speak to me. I hope you're keeping well. It's nice to see your face again. We haven't seen each other in person for months now, have we? But yeah, thank goodness for video calls.
Absolutely, Zoom.
So Andy, look, in terms of holiday lets, which is what we're going to be talking to you about today, which is one of your real areas of expertise, I think it's fair to say that at Mortgages for Business, we have absolutely seen an increase in the number of people who are interested in obtaining finance to acquire a holiday let. So in your opinion, is now a good time to be investing in holiday lets as an investment property?
Yeah, thank you, Jenny. Yeah, absolutely. The last 3 years, it's been boom time for holiday let mortgages. In fact, it's been one of our areas of business that has just been growth year after year after year. We deal with a number of lenders, but one of our standout lenders, we've probably written about 53, 54 cases, totaling about sort of £16 million of business, with an average holiday let loan around about the sort of the £320,000 mark. So it's been great business. Our clients have looked at these investments, and they are higher yielding than standard rental investment property. And of course, you've got the tax efficiencies of the holiday lets as well. So, for example, you can offset a lot of your costs. If you're running a business, you can offset your things like your council tax and expenses. And other benefits for the holiday lets is that because they're treated as businesses, you can get entrepreneurial relief, you can get capital gains tax relief, capital allowance relief, and it's just great business. Plus, also the UK, the weather in the UK in the summertime has been absolutely fantastic. So people are also taking advantage of holiday letting the property, but also using that property for friends or family, or even taking some breaks out of season yourself. It's just been brilliant business.
And just going back to what you mentioned about the tax, so am I right in thinking that holiday lets aren't subject to Section 24 in the way that normal buy-to-lets are? Is that right?
That's correct. Yeah, there's a lot of allowances that you can offset. It's as if you're running a business, or all your interest costs can be offset. You can offset your expenses, and it's just it's a very tax efficient way, and probably more tax efficient than running just a standard buy-to-let portfolio.
Sure. Okay. So in terms of the actual kind of experience of running a holiday let, and you're obviously dealing with lots of people who have these, what would you say the real pros are of having a holiday let, and what would be probably the most notable downside of having a holiday let, would you say?
I think that the pros of owning a holiday let is basically the income that can be generated from these properties. But also, we're starting to see clients that are not just purchasing one holiday let; they might be purchasing 2 or 3 holiday lets, and they're purchasing those into company structure. Some of these businesses can generate 40 or 50,000 of net profits per year. When you look at that as an overall scenario, the actual limited company will sort of have goodwill allocated to those holiday lets. So the goodwill value could be a couple of times adjusted net profits. You're running 3 holiday lets, producing 150 profits a year, and you've got £300,000 worth of goodwill there. Plus, you've also got the rising value of the actual freeholds themselves. And they're just great. They're just great businesses at the moment.
Okay. Well, I always think one of the probably the biggest downside I think of having a holiday let is just they're, I suppose, in theory, much more labour intensive because you're having to handle the changing of I want to say tenants, but that's not the right word. Holiday makers, the cleanliness of the property that needs to be monitored. I suspect there needs to be probably, I don't know, this may be unfair, but a stronger level of maintenance. If you're going on holiday somewhere, you expect it to be very, very nice and pristine when you turn up. So I'm guessing that, just the ongoing running of it is more intense than it would be on a normal buy-to-let. And that would be, to me, I think, the natural kind of trade-off for that wonderful yield that you refer to.
Absolutely, yeah. There are costs involved in running these holiday lets. For example, the changeovers, the booking costs, the maintenance of the lawns, or hot tubs or swimming pools that are actually at the holiday let properties. So there are some sort of costs involved, but you tend to budget that a reputable holiday letting agent will probably charge between 15 to 20% for commissions and changeovers. But on an average, £400,000 property that's generating 40,000 of rental income per year, that there's more than enough money in the pot to cover those costs.
Absolutely. Okay, so look, when we're looking at people wanting to invest in holiday lets or borrow money more generally as a mortgage, affordability always comes into it. So how much can I actually borrow? And we all know that from buy-to-let mortgages, the rental income essentially drives the amount that you can borrow. So when lenders are looking at holiday let at mortgage applications, is it the same kind of principle that applies?
It's a similar principle that will apply. There are a few lenders that they'll always look at background assured short hold tenancy income to work out how much you can actually borrow. But there are other lenders in the marketplace that will actually look at projected holiday letting income when they're assessing the debt serviceability. So, for example, what you tend to find is, say, a £500,000 property in somewhere like Cornwall might only generate 1,000, 1,100 of standard rental income, but that property might generate between 40 and 50,000 pounds of holiday letting income. And the lenders will, if the lenders are lending against projected incomes, they can always lend you more money.
Right.
So an example would be, if we've got a property that is, say, £400,000, and you're looking for 280,000 of mortgage, the projected holiday letting income will more than service that. Whereas if the lender is taking into account assured short hold tenancy income, they might only be able to get to sort of 180, 190,000 pounds of borrowing on that rental income. There's a vast difference there.
Okay, so it's really important that when we're looking at, or clients are looking at, which lender to approach, they understand which figure they're going to be working on when determining affordability to make sure they're going to the right lender in the first place.
Absolutely. I mean, golden rule of thumb is, if it's a higher valued property, you're going to need to find a lender that will lend by projected holiday letting income. If you're looking at, say, a small flat in a seaside location, the assured short hold tenancy income should service the mortgage. So the higher the value of the property, you'll tend to need to find a lender that will work from projections. The lower valued properties, you can find lenders that can work with the assured short hold tenancy income to get to the debt level that you require.
Okay, cool. And so keeping on with the vein of lenders' kind of underwriting and risk appetite, what else are they looking for? Do you need to have experience of holiday letting or, buy-to-lets more generally, for example?
With some lenders, they will require you to either be a homeowner or to own one or two rental investment properties. But there are lenders in the marketplace that will lend even if you're not a homeowner or you don't own rental investment property. As long as you've got some good background income and you have your deposits to put in, there are lenders that will consider lending to you. And that's very much different from the buy-to-let scenario, where lenders would always need you to be, homeowners or own rental investment properties if they consider lending. And you often find that the commercial lenders as well, they've got much more flexibility with the lending deals because they've got more of a sort of a commercial appetite, and not every case fits one and all.
So they're less computer-based decisioning and more commercial. People underwrite applications and take an overall view on the application.
That's it. Yeah, spot on, Jenny. An overall view on the application. It's applying common sense to the lending, which is great to see.
Yeah, definitely. And so how about if someone wants to buy a holiday let through a limited company? You referred to this a moment ago. So that's okay, is it?
Yeah, that's absolutely fine. The lenders can look at lending to trading limited companies. The lenders can look to lending to property holding companies. Not a problem at all. You tend to find that if you're borrowing in a company structure, you're generally able to borrow a little bit more, and that's much like with a standard buy-to-let mortgage.
Okay, fair enough. And what about property types? So, are we restricted by, only houses or location, or can we have, chalets on a resort? Actually, what kinds of properties are okay for the lenders?
Yeah, generally all of the properties are okay. Houses, flats, holiday let properties with restrictive covenants. There are lenders that will look at those deals. I think one of the key pointers is if you're looking at let's say a flat in a seaside location, obviously you have to check out the lease to make sure that you're able to holiday let that property.
Right.
Some of the flats that are coming up in some of the holiday let locations, the developers know that a lot of these properties are going to be holiday let, so they build that into the to the lease that they make available.
I see. Okay. So the key message here is that some properties come with a title which restricts their usage. And so it's just worth, if you're thinking about investing, just understanding what that actually looks like before you start spending money on valuation fees and all the rest of it.
Absolutely. Yeah, because you can see some properties in holiday let locations that appear to be very cheap. They may have restrictions that those properties can be holiday let only. Well, for example, I had a case today from an applicant that was looking at a property with restrictive covenant, very good value, potential yield of £20,000 to £30,000 per annum. But we were able to find a lender for that deal, and the rates were a little bit higher for properties with restrictive covenants, but they were no more than the sort of the 4.5% mark approximately.
Okay, so it can be done.
Yeah.
Perfect. And I suppose just touching on the interest rates now that you mentioned them. So you mentioned sort of 4.5% rates. Is that a kind of standard holiday let rate?
That's towards the higher end of the holiday let rates. And those sorts of rates would be available as well for clients that maybe they had a main property and they had, say, 3 holiday lets in the grounds. Those sort of rates would be available for that deal. But, generally for vanilla holiday let property, you're going to pick up rates anywhere from about the 3.4% mark through to about 4%. Some of the lenders have no age restrictions, which is fantastic. And the arrangement fees, they will vary between sort of £999 and at the higher end towards 2% of the actual borrowing.
Okay. And can our borrowers get interest only, 25-year term, or are these more restricted sort of commercial type terms, so it's only 5 years?
A lot of them are commercial loans, but the beauty is that they will lend interest only still. So, holiday let interest only, tax efficient, fantastic. A lot of investors will go with those types of deals. But there are other investors that may say, well, we're taking a long-term view on this. We'll take a 25-year repayment mortgage, and they may go down that route. But so options available, horses for courses, as they say.
Fair enough. So in summary, you don't have to have experience of letting property necessarily. Pretty much all types of property can be considered. You can do this personally or through a company. The rates are kind of mid-threes upwards, broadly speaking. You can have interest only or repayment. You can have a long term. So it all sounds like actually the holiday let lending proposition, compared to how I understand it from back in the day, has come on absolutely strides, hasn't it? It's really become very mainstream by comparison.
is come on. It's come on leaps and bounds. I must admit, in the last sort of 12 months or so, we've probably gone down from about sort of 18 lenders down to sort of around about 10 lenders, but they're 10 trusted lenders that do some fantastic deals. I do expect that the interest rates for the holiday lets, because it's going to be big business again this year with people's staycations, I do expect the rates to come down a little bit. I think as there's a bit more competition in the market, people needing these holiday let mortgages, the lenders will tune into offering some lower rates. And I think whereas the buy-to-let rates may have reduced a little bit over the past sort of 12 to 14 months, the holiday let rates have gone up a touch, but there's still good money to be made from the letting of those properties.
And is the number of lenders going from 18 to circa 10, is that really a COVID thing? Or is that something else at play here, do you think?
There's a few lenders that have just got the jitters and, kind of pulled out of the market. It's one of those things. But in fairness, they were lenders that we didn't often use a lot. The lenders that have always been in the holiday letting business, they remain in this business, and they will be there to support our clients. Yeah. It's also interesting to note as well that when new lenders are coming to market with holiday let propositions, because we do such a volume of business through Mortgages for Business, they're often on the phone talking to us, and they're asking us what we need from these holiday let products, where to pitch it, where to pitch the rates. What do we lend on? Do we lend on projected AST, or do we lend from standard AST rental income? So the lenders are in touch with us, and the team at Mortgages for Business, we've got some really great options for our clients.
And one last question, Andy, because this is something that I know we saw a huge amount of before lockdown 1. Many moons ago now, which was Airbnb, which, as I understand it, is not necessarily the same as holiday letting. Is that right?
Yeah, that's a fair assumption. You tend to find you get a lot more Airbnb property in sort of city locations, and you tend to find that maybe people that are going through Airbnb and booking holidays, they might only be staying for 2 or 3 days in a city. Whereas the holiday letting property in coastal location, you're much more likely to get sort of, a booking for at least a week. And then so there are lenders that if it's an Airbnb property or it's marketed on Airbnb, they won't lend to you. And quite often it's because of they know that there's going to be lots of bookings at the property. And they're not completely comfortable with having so many tenants within that property. So some lenders will not lend on Airbnb property, but we have options for all of these types of mortgages.
Perfect. Andy, genuinely, we do recognise that holiday letting is going to be a big growth area this year. As you mentioned, staycationing is the go for 2021. Fortunately or unfortunately, depending on how you view it. So I'm sure that lots of people who are watching this are going to be really interested in the information that you've shared with us. So thank you so much for imparting your pearl of wisdom. No worries. Thanks, Andy. So now we're going to move on to my last guest of today, and I'm delighted that I was joined by Mark Posniak of Octane Capital. Now, Mark told us that he has been in the bridging and specialist end of lending since as long as he can remember. He started his career at Cheval, and then in the aftermath of the financial crisis in 2008 was absolutely integral to the launch and growth of Dragonfly Property Finance. When I think about people who know about refurbishment finance and development finance, Mark is the first name that springs to mind. To my knowledge, he is probably one of the most experienced industry leaders that there are. So we were really happy that he was able to devote some time to speak to us. Now, unfortunately, because he is so good, he was unable to actually join us for the live recording of today's session. So actually, I caught up with Mark earlier today for a pre-recorded video. Now, unfortunately, my Wi-Fi in true lockdown style wasn't working very well. And so you will find that the video quality is slightly laggy for this particular session. What I would say is the sound quality is absolutely perfect. So you'll be able to hear everything we have to say, which is a real godsend, actually, because sometimes what Mark has to say was really, really fascinating, and I was really happy to catch up with him. So Mark, thank you so much for joining us today. Really appreciate you taking the time. I know you're exceptionally busy at the moment. So look, landlords are always looking for ways to add value to properties. And with the relaxed planning laws, we really think people are becoming increasingly interested in refurbishment and development projects. And I think we are definitely seeing a spike in interest now as people really start to eyeball commercial property, which is becoming increasingly vacant with a view to converting it to residential. So I guess the first question I really wanted to ask you was what types of permissions are actually needed to convert mixed-use property to residential dwellings, and also to convert existing residential properties into multi-units?
Yeah, I mean, you're 100% right. Firstly, thank you very much for having me on. I really appreciate the invite and hope I can share some of my knowledge. Won't take long with your listeners and people who are watching. In answer to that first question, it's a massive opportunity, and we're seeing more and more of these transactions every single day. The big thing to look out for is to check, unless there are any Article 4 directives in place specifically precluding change of use to residential, both offices and retail properties can be converted under the permitted development. But they do require formal prior approval from the local authority before doing so. And certain criteria will also need to be met. Things that need to be considered are transport, contamination, flood risks, noise, etc. It is worth noting, though, that although a lot of people are doing these permitted development schemes, the real value comes in when they go take it from a PD scheme and actually apply for planning to enhance the square footage, enhance the number of units, and enhance the look and feel of the building, because a lot of these buildings don't actually lend themselves to be converted very well. And it's all very well and good saying, oh, look, I'm going to convert this office into residential, but nobody wants to live there because it's the most ugly looking building ever, doesn't have great insulation, and is very, very noisy. So you need to look at each deal on its merits. You need to look at each building on its merits. But it's a massive opportunity for developers and for investors, and the planning laws and rules and regulations around it do lend themselves to increase the business in this area.
Okay. So if I was a landlord and I was thinking about doing a conversion, I mean, what would be my first port of call? Do I need to get an architect involved? Like, how do we even begin to do this kind of thing?
You'd have an architect, you may have a planning, you may go to a planning firm, you may go to a lot of people have already got these teams in place. So typically I think it would be an architect as a first and foremost, just to understand the building. From there, you would then take it to a planning consultant and say, listen, this is where I want to go. If you want to get real space. If it's a small conversion, an architect's typically enough. They can help you through the planning. A lot of the smaller developers will just do it themselves because, if it's a retail shop with a flat upstairs or, a retail shop with a couple of offices upstairs, it's a much easier conversion than a big office block, what have you. So the bigger office blocks, you've typically got very, very professional teams in place. But it's all about actually what they want to deploy, if they want to go into the airspace above as well. As soon as you start going like that and talking about real planning permission, you have to have structural surveys done and make sure that you're looking at it holistically, not just, okay, well, look, this is the floor plate, I can get this many units in and away we go.
Okay, I see. So in terms of the permitted development regulations, what actually is kind of covered under those at the moment in terms of what you can do, broadly speaking? I know it can be quite specific, this, but just in the round.
So, I mean, there were new planning regulations that came into force, I think on the 1st of September 2020. And in terms of PDR, these included, firstly was the right to demolish and rebuild redundant commercial buildings and replace them with new dwellings, subject, of course, to prior approval, but not full planning consent. And I think the second was the upward extension of up to 2 stories above existing post-war built homes, offices, shops. Again, subject to prior approval. And I'm not sure you need full planning on that, but obviously they'd need to talk to their lawyers and planning consultants and architects accordingly. I think the big thing here, though, Jenny, is that what you're finding, not just commercial to resi, it's also resi to resi. And what I mean by that is the number of opportunities that we are seeing at Octane at the moment are, yes, we're seeing the PD schemes, we're seeing the conversions from offices to resi, and changing the high street into mixed use with retail downstairs and some flats upstairs. But what we're seeing more of is actually what we call the portfolio builders, and the guys who are looking to enhance their existing portfolios. So either people coming to us saying, listen, I've got a portfolio of 5 or 6 properties. I really want to ramp it up now because people can't afford to buy. First-time buyers have been priced out the market. They're almost impossible to get mortgages for, and it's increasing rental demand. The problem is, although the rental demand is increasing, the yields aren't. So what these people are looking to do is they're looking to either A, convert their existing portfolios into HMOs or multi-lets or multi-rooms, or B, acquire new properties, bridge them, apply for planning to convert them into HMOs. We then flip it onto a refurbishment facility and fund the works 100% for them in arrears. And then once it's finished, flip it onto a 5-year buy-to-let product, releasing their equity to allow them to go again. And those, I would say that at least 20 to 25% of the business we do is in that end-to-end life cycle lending, where you help them at each stage of the process, whether it's an acquisition day one, or some of them already own it and you flip it straight into a refurbishment facility, pulling out some cash because a lot of them are lowly geared. Why they're lowly geared? Because they've had these loans on these properties for years. The value's gone up, the rental income hasn't, and because of that, they can't get high loan to value buy-to-let loans. So these people are manufacturing value out of their existing portfolios to pull it out and reinvest and go again.
Okay, that's really interesting. So I guess really, and then moving on to more the financing of the conversion works and those kinds of projects. And I know bridging finance is often used for this, but maybe you could just explain to us and the people watching this exactly how bridging finance can assist landlords with refurbishment and conversion projects.
Yeah. So typically the refurbishment projects that we fund come from experienced developers or property investors who are looking to enhance the value of their existing portfolio or existing properties, or indeed buying new properties. And the way bridging finance companies help is because what we can do is we can fund the works to convert that property or to extend that property or to change that property. So we can either do it in 2 stages, where if it doesn't have the planning, as I said before, you give them a bridging loan while they take the property through planning. That typically takes 12 to 16 weeks. It can be quicker, but on average, I'd say that's probably the best bet. So somebody says to you, can I have a 2-month bridging loan because I'm going to get planning in 4 weeks? You can straight away say, okay, this might not be the right person to back, but you never know. They might just be really experienced. They already put their planning submission through, etc. But it's typically, let's say 8 to 16 weeks. You can then, once the planning is in place, often that value will go up slightly. And if it does, great. It allows you to then, when you flip the loan into a refurbishment facility, give a little bit of money towards the works. Sometimes it doesn't, though. Sometimes the value stays the same because they've already paid for it with hope value for the planning already to be granted in their heads. And in that scenario, what we say is we will fund 100% of the cost of the works to convert or refurbish that property. But we do it in arrears. Why do we do it like that? Because we need to make sure the project is fully funded. So we say you spend the first 20% and then we'll fund that 20% back to you. And then you spend that and we give that back to you again. And we do that constantly in arrears to the point where we give them 100% of the costs to refurbish that property. When it gets to the end, that property, instead of being worth 500,000, is now worth 900,000. They may have only spent 120 grand on it. That uplift is massive. But more importantly for some of the people who we're backing is they're doing it to hold and not to sell. It's fine if they want to sell and they can go and sell it and go again and pull all that cash out and deploy it into whatever they want to deploy it into. But a lot of our investors are saying, okay, that's it. Now I've got this property. It's kicking off 8% yield instead of 3%. I want to hold this long term, but I need to pull that money out. I've made all this profit. What do I do now? Yeah. So what we do in those scenarios is, if it's a nice small 6-bed HMO that they've converted it into, we'll give them a 75% buy-to-let loan, pulling out that extra equity between where we've ended up and where the new value is. And then typically they'll say, okay, great, that's my deposit for this next deal over here. Can you fund that for me? And
in terms of when you're talking about the payments being in arrears, how do you actually do that? Do you send out a QS or do people just send you receipts?
Depends on the size of the scheme. The way we do it is we have an asset manager typically who goes out on the first instruction So before we complete the loan, they go and assess the property. They look at the client's schedule of works. They look at the team who's going to be used to do it. Because we're always looking to make sure the borrowers have got the relevant experience and know how to do these refurbishments and got the team in place, etc. You can tell very quickly when you're underwriting an application if somebody's done it before, right, just by the quality of their schedule of works, their program of works, how long they think each thing's going to take, their discussions with our asset manager, who obviously manages our hundreds of refurbishments that we've got going on at any point in time. So we get a real good feel for their exposure and their experience. The process is our asset manager goes out day one. They do a report for us. They look at the schedule of works. They say, yep, that ties in nicely. We think they can do it for that. They've got a good team. They've got a good project manager. Let's go. And then they go and spend the first, let's say, 20%. That might be on doing some of the strip out. It might be actually knocking down a couple of the walls and starting to do the extension. It could be various things. At the point they've spent that 20% and they can evidence it to us, their broker gets on the phone to us saying the client would like the next drawdown. This process is so seamless when working with a specialist lender like ourselves that it takes a couple of days. We get our asset manager back out to the property. They've already seen it. It's not like we're sending multiple different people. So that asset manager goes out, they look at it, they do a report for us, they look at what the client's invoices are, they look at the works, they can see what it was based on the first time they were there as well. And they go, yep, I'm happy with that. They send us a report. Within 24 hours, the client has that next tranche of funds. And we factor the costs of these asset manager visits in at the outset. So our asset manager fee comes off our admin fee. For small refurbishments, that typically will cover all of them. But for your larger deals, which have multiple drawdowns, like more than 2 or 3, after the second or third drawdown, we charge, I think it's £295 for our asset manager to go and do subsequent drawdown visits. The reason why that's so cost effective is that if you instruct a QS for a small refurbishment project, it's just going to pull out all the profit. All the profit's going to go to the QS because it's going to cost a couple of £1,000s per visit. So yeah, on a bridging loan, on a smaller refurb, a smaller conversion, we try and avoid QSs. Obviously, where there's a lot of structural work and there might be a basement and there might be huge extensions and they might be spending 500k plus. In those deals, the chances are we would instruct a QS.
Okay, thank you. And so it sounds like you guys are dealing with some fairly experienced investors. But in terms of, I guess, accessing this, if you're not such an experienced developer, where's the appetite? Who are you looking to really lend to? Who can do these kinds of projects?
So we will lend to people without as much experience, but in those circumstances, we want to make sure they've got a really good team in place and a good project manager who has encountered what they're going to encounter when you do a refurbishment or a conversion or a development. We've done them ourselves. A lot of us within Octane have done our own projects. But more importantly, our asset managers have seen loads. We know that things can and often do go wrong. And your novice investors who think they watch a TV show and say, oh, I can do that, I can make that. They don't realize that you have weather delays and you have staffing issues and you have whatever issues may come. You might hit with the services and you hit a pipe. There's so many things that can go wrong. And actually what you want to make sure is that you've got a project manager and a team that know what they're doing. More importantly is if you're going to back a novice investor, you want to make sure you're backing somebody who, this isn't their first ever project on anything and they only own their house and they now want to be a property developer and a property investor. We're a little bit more cautious with those borrowers.
Yeah, I think that's a really good shout. I think we do get calls from people who have watched, at least our programs on TVs have got a lot to answer for, haven't they? And they want to get
I like watching them. I'm not sure if I'm
exactly. But yeah, I do see absolutely that experience is absolutely key. And I suppose from your perspective as a lender, particularly in the space that you guys operate in, and I understand that you were saying earlier that you're able to offer an exit to your borrowers, which is fantastic, a longer term exit.
Yeah.
Apart from exiting with yourselves, what other exits would you be looking for? I'm guessing sale of property would be another one.
So, listen, there's only 3 exits really. The one is exit with ourselves, and that's the most popular because we've got such a great 5-year offering, which allows them, as I said, to pull that cash out and go again, and often will then fund that further acquisition as well. They can refinance it to the high street. So if they're an A1 client with a nice portfolio and there's lots of rental cover now coming out of this property, they can go to the high street. Everybody's clambering over each other in terms of buy-to-let lenders trying to get the same deals. Let them go and fight for those, and if they fall outside for whatever reason, we'd love to have them. As you know, our buy-to-let proposition is we've set out our stalls to sit just outside where those high street banks are trying to kill each other and those challenger banks are trying to kill each other for no margin. So they can refinance with us, they can refinance with them, or they can sell the property. Either option works for us, and we're happy, provided obviously it makes sense and that the exit makes sense.
Perfect. Mark, that's been really useful. I'm sure everybody watching this is going to be now leaping onto Rightmove to try and find a renovation project.
So when they do come to me, especially if they want to hold it afterwards and put it onto our buy-to-let product.
Yeah, that sounds amazing. Thank you. Thanks so much for your time today, Mark.
Thanks, Jenny.
Cheers.
Bye.
And now we move on to my favourite part of the event, the Q&A sessions. First of all, thank you to everyone who sent in questions in advance of today. So look, what have we got for you? The first question I've been asked is, can I have multiple bridging loans going through at the same time, buying in a limited company name? So the answer to that is that there's no reason why you can't have multiple bridging loans going through at the same time. The lenders don't restrict this. There's no rules that say you can't have that. I think obviously there's the issue of cost. Bridging loans are more expensive than traditional mortgages. Obviously, you might have a fairly high amount of cost running through your books at any one moment in time if you were running these in parallel with each other. But absolutely, yeah, there's no reason why you can't have more than one on the go at the same time, definitely. We've also been asked, given the current climate on the high street, I'm receiving requests from my commercial tenants to turn their A1 retail units into takeaways. Given the takeaway would be on the ground floor of a building I own, which has several mortgaged residential units above, is a takeaway unattractive and something which will limit my options in terms of freehold and mortgaging in the future? So look, yeah, absolutely. If you were to want to take a buy-to-let mortgage, which is above, I mean, any commercial property can be contentious, but particularly anything where it is open late, it is noisy, there can be smells coming from it, where people kind of tend to congregate later in the evening, you will find that lenders' appetite to lend really does start to diminish quite rapidly. There are lenders who will lend on these types of properties. You know, definitely there's a place in the market for those. But you will find that potentially the rates could be higher, or likewise the loan to values could be restricted. So, I think to answer your question, that could be a sticking point for you going forward. Sorry about that. Another question I've been asked is, what is the big advantage of moving buy-to-let property from personal names to limited companies? Now, look, the reason we are seeing such a swing towards limited company lending is all about tax on the back of Section 24. So the way that you are taxed through a limited company can be more favourable for you than if you were to own the properties personally and pay tax that way instead. This really tends to be more the case for those people whose total gross income, so all employed income or self-employed income plus turnover of rent, if that would push you into the higher rate tax bracket. But I mean, we're really moving into the realms of tax advice here, and I'm not qualified to talk to you about that. But that's the absolute number one reason. So if you are thinking about using a limited company, whether it would be right for you, it's really worth investing some time and, you know, probably money, but not much, to speak to a tax advisor who can really guide you on this. Now, there are other reasons why people use limited companies. It's not that there was no limited company lending before Section 24 and suddenly everyone's doing it. So other reasons people would use limited companies. So first of all, it offers more flexibility in terms of ownership. So it's easier to kind of issue new shares in a company. So for example, if you, had a limited company owned by you and partner or husband and wife, and then actually you wanted to bring your child into the mix, you could issue some shares to them. Whereas if you own a property personally, just husband and wife, it's quite binary. Actually adding people on and taking them off is much more kind of restrictive and involved. So people quite like it from a kind of flexibility and also a planning perspective, legacy planning. The third reason, and the other main reason why we see people using limited companies, is about essentially being tax efficient with how we use money that we have in a different existing company. So if you imagine, if you were a company director, you owned your own business and you had an amount of cash that was built up within your limited company, and then you decided that you wanted to use that money to fund the investment of a buy-to-let property, you kind of have, I guess 3 options here. So the first option would be that you would simply buy their property through the existing company, but that company would be cast as a trading company. Some lenders don't like lending to companies that do anything other than rent out property. But likewise, some people want to keep their business, the day job, as it were, separate from the other stuff. So that is one option. So buy through the existing company. The second option would be you withdraw the money from your limited company into your personal name, and you could buy personally. Withdrawal of that money could be a taxable thing. So you would need to get advice from your accountant about whether there's any way of doing it where it would be more tax efficient, so repayment of director's loan, for example. But fundamentally, most people find putting that money out would trigger a tax payment. And so the third option would be to set up a new limited company. So you can essentially move money from trading company to new company. And there are ways of structuring things so it doesn't have to come out via you. So rather than it going trading company to you to limited company, which would therefore be taxable potentially, what you can do is set things up in a way where you can move money from trading company to new property letting company. And that's what we see a huge amount of at the moment. Now, the ways that you can do that, there's a few ways of kind of skinning the cat, as it were. That's something that you would really need to speak to your accountant or a tax advisor in terms of how they would want you to do it. Just know that as a mortgage brokerage, we can help you whichever way you do decide to do this, but there are some options. That's the kind of key 3 reasons why people are using limited companies at the moment, and I hope that answers your question. Now, the last of our questions that I'm going to cover off today, because I am very conscious of time, is a question which says, finance via a bridging loan. How soon do you have to pay it back, and what are the costs, especially if you're relying on remortgaging the property after 6 months? Is that still possible? Okay. So bridging loans are traditionally available for up to 12 months, but these days there are some lenders who make them available for 18 and even 24 months. So really you can essentially have a really long period of time to take away any kind of pressure and anxiety of having to kind of turn everything around really, really quickly. So the very short answer is that actually 12 months is absolutely on the table, even 18 and possibly 24 months. What I would balance that by saying is because bridging finance rates are quite expensive, I don't imagine you would ever aim to be on bridging finance for any longer than you had to. But the point that you raise here about remortgaging after 6 months is a very good one. But actually, I think it's worth just touching on a bit further. So there is a perception, and a fairly justified perception actually, that you cannot refinance a property you have owned until you've recently purchased, until you have owned it for at least 6 months. Now, there are definitely lenders who will not refinance a property that you have owned for 6 months, but just know there are also lenders who will absolutely remortgage a property within that time frame. And really then it comes down to what value they're going to place on the property. So from the lenders who will do a remortgage within 6 months, we call this an early remortgage, incidentally. Some will say, well, okay, we're happy to do this, but the value of the property, irrespective of how much it is actually worth, for us will only ever be how much you have paid for it plus what you have spent on the property, so cost of works. So assuming that figure will come in lower than the open market value, doesn't matter, they're still going to lend against that lower figure. However, there are also some lenders that say, look, as long as we can get comfortable as to how come you've seen an uplift in value. So, for example, you have done works to the property, we're quite happy to remortgage at value within the first 6 months. So there are options there as well. So what we often find is there are people who take on very, very light refurbishment projects, which they can turn around in a really quick space of time. And actually we're able to exit the bridge earlier than 6 months for some of these clients, which actually is a really good cost-saving thing. So again, I hope that answers your question. Now, that's all of the questions I'm going to cover off today. I will be emailing every single person who has taken the time to ask us questions to answer theirs directly. There were quite a lot of questions, so we just simply don't have time to cover them all today. But like I said, I will be in touch with each of you to run through your questions separately from this. And that really wraps things up for today. So look, I really do think that you found today enjoyable. I have thoroughly enjoyed every single conversation with our guests, and thank you again to them for taking the time to come and talk to me. It's really appreciated. Mortgages for Business, our doors are open, our phones are, ready for you to ring. Do give us a call if you have any questions about any of the content today or anything buy-to-let or investment mortgage related. Our number 0345 345 6788. Our website, if you're not familiar with it, is absolutely full of information. There are blogs, there are case studies, there are calculators. How much can you borrow? Or, what's my stamp duty going to cost? It's just absolutely full of information. So do go and have a nosy around on there if you have some time. mortgagesforbusiness.co.uk. And so lastly, just from me to say thank you so much for taking the time to join us today. We do genuinely appreciate it. We know everyone is very, very busy and an hour of your time is really precious. So thank you so much for that. And we genuinely do really hope to hear from you soon. We'll be lovely to have a chat with you, and catch up and see if there's anything we can help you with. Thanks again.